It's the final boss of the central banking world and the architect of CBDC projects everywhere. And naturally, the Bank for International Settlements is no friend of crypto either, perceiving it as a threat to central bank control. But as the BIS's latest research on cross-border crypto flows makes clear, crypto's parallel financial system is rapidly gaining ground. It's great news for us and terrible news for them. So, should we be celebrating, or perhaps worrying about central bankers putting crypto back in the crosshairs? Today, we investigate. My name is Guy, and you're watching The Coin Bureau. If you're not familiar, the Bank for International Settlements, or BIS, is basically a bank for central banks and international financial institutions. The BIS is headquartered in Switzerland and is owned by its 63 member central banks, for whom it operates in the private market as a counterparty, asset manager, and lender. As the central bank's ringleader, the BIS has been leading the global charge towards the creation of central bank digital currencies, or CBDCs. It wasn't always this way, however. BIS head honcho Agustin Carstens said in a speech as recently as 2019 that there was, quote, no clear demand for CBDCs on the part of society. However, the pandemic-era crypto boom seems to have changed his mind. Carstens and his colleagues have since become CBDC evangelists, positioning them as a safe, reliable, and publicly oriented alternative to private digital currencies, i.e. crypto. The BIS has now published a vast number of influential reports, working papers, and speeches on CBDCs. And these have become the foundational materials for many central banks worldwide, with the BIS serving as the conductor, making sure they're all playing, more or less, the same tune. Now, central to the CBDC push is the BIS Innovation Hub, the internal think tank established by Carstens in 2019 to foster international collaboration on fintech. This means a whole lot of CBDC scheming, with the hub heavily involved in research. It also actively runs pilot projects with various central banks around the world through its outposts in Hong Kong, Singapore, Switzerland, the UK, Norway, Germany, France, and Canada. The hub was behind, for example, Project Enbridge, the cross-border payments pilot that was abandoned last year after complaints that it would undermine the United States' ability to sanction other countries. Not to fear, though, the hub has many other projects underway, like Project Dunbar, Project Helvetia, Project Aurum, and Project Seller. Another is Project Nexus, which aims to unify the currently fragmented landscape of instant payment systems that exist around the world into a global network. This is supposed to reduce transaction costs and increase speeds and transparency for remittances. At the project's inception in 2021, the head of the Innovation Hub, former European Central Bank executive Benoit Cœuré, explained, quote, Project Nexus is trying to achieve the equivalent of internet protocols for payment systems. That means creating a model through which any country can join by adopting certain technical and governance requirements. A payment system's equivalent of internet protocols, you say? Well, that's an interesting idea if only someone had thought of it sooner. Interestingly, there's no mention of blockchain or crypto in the official project literature. Not even distributed ledger technology or digital assets get a shout-out. And this seems like a pretty conspicuous omission, considering that many of the problems Project Nexus is supposed to address have found a very popular solution already in crypto, which is nothing if not a payment systems equivalent of internet protocols. Stablecoins and low-cost, highly performant blockchains in particular look like an elephant in the room here, enjoying rapid adoption as cheap, fast, and reliable means of cross-border payments for individuals, businesses, and institutions. But instead, the official project literature emphasizes how Nexus will, quote, open the door to alternative payments infrastructure such as CBDCs. Nexus, which is slated to go live in 2026, is designed to ensure cross-border transactions comply with as many regulatory regimes as possible. This means not just anti-money laundering, combating terrorism financing and sanctions screening rules, FX and capital flow management measures and reporting requirements, but also each country's domestic monetary and financial stability policies. Financial stability policies sounds a bit euphemistic and could mean just about anything a government wants it to, doesn't it? Now, although the project literature doesn't acknowledge the popularity of crypto as a solution to the problem of costly and slow cross-border transactions, the BIS is well aware of this state of affairs and is watching crypto like a hawk. As you would expect, the BIS is no fan of crypto, having variously dismissed and warned against it over the years. You know the story here. First, they were dismissive and said it wasn't important. Then they said it was a danger for investors and, at worst, a tool for illicit activities. When Agustin Carstens became the head of the BIS, crypto prices were plunging from the heights of the 2017 bull run. In an inaugural interview posted on the BIS website, he struck a more caustic tone, signalling that the bank would be more proactive in its opposition to crypto under his management. Quote, "Cryptocurrencies are a bubble, a Ponzi scheme, and an environmental disaster. While central banks are not law enforcement authorities as such, they can still show how these pseudocurrencies serve as vehicles for illegal activities. Cryptocurrencies are neither a good means of payment nor a good unit of account, nor are they suitable as a store of value. They fail dramatically on each of these counts. So, my message to young people would be, stop trying to create money." Thankfully, nobody took his advice, and shortly afterwards, stablecoins and DeFi exploded in popularity. And as crypto became more sophisticated, interconnected, and popular, BIS critiques increasingly focused on the so-called illusion of decentralization in DeFi and the potential for stablecoin runs. You can imagine then the field day they had in 2022. This was, of course, the year of Terra, FTX, Celsius, BlockFi, and things breaking all over the place in crypto. But amid all the chaos, stablecoins provided a path to safety for people in countries worst affected by fiat currency depreciation. The BIS observed this vector of crypto adoption in Turkey and Brazil, for example, and warned of the cryptoization of their economies as citizens fled to crypto, possibly undermining local monetary policy. Unsurprisingly, the BIS doubled and tripled down on CBDCs as the way forward, framing them as the safe and trusted evolution of money, positioning them as superior to and a necessary counterweight to crypto. They are, in reality, a land grab by the global financial order to neutralize the threat to centralized control posed by permissionless blockchains. And all this brings us to the present moment. There is now significant political opposition to CBDCs and dissatisfaction with the role of the BIS Innovation Hub. The BIS is trying to respond to this by placing a greater focus on public trust and legitimate concerns around surveillance and privacy in CBDC research and development. Still, there's no indication that central banks will cede an inch of control over CBDCs. Agustin Carstens has explicitly said that with CBDCs, central banks will have, quote, absolute control on the rules and regulations that will determine the use and the technology to enforce that. Meanwhile, crypto continues to mature as an asset class and a technology, enjoying adoption by more and more people and bigger institutions. It's clearly not going away, and recently this seems to have led the BIS to take a much more nuanced and data-driven approach to understanding how crypto is being used. Of course, what hasn't changed are the conclusions. Crypto needs greater oversight and integration into existing regulatory frameworks, or the development of new ones specifically to manage the threat it poses to central bank control.
Well, hello there. I know you're enjoying the video immensely, but I just very quickly want to tell you about the Coin Bureau deals page. Now, if you're looking for some of the very best deals and promos in all of crypto, such as, for instance, up to $100,000 in sign-up bonuses and up to 60% in trading fee discounts on some of the top crypto exchanges out there, as well as insane discounts on hardware wallets and much more besides, then check out the Coin Bureau deals page in the description below. And now, back to the video.
Now, all of this should provide us with some useful context for understanding the BIS's latest contribution to the academic literature on crypto. This is the new working paper published by the BIS and titled Defying Gravity, an empirical analysis of cross-border Bitcoin, Ether, and stablecoin flows. The paper begins with a standard disclaimer that, quote, the views expressed are those of their authors and not necessarily the views of the BIS. But we think this can be safely dismissed, as the lead author is Raphael Auer, the head of the BIS Innovation Hub's Eurosystem Centre. Auer is one of the leading architects of the global push for CBDCs, having published much of the foundational research outlining their potential and mechanics as a future form of money. By contrast, his work on the, quote, shadow crypto financial system frames crypto as speculative, risky, and a threat to regulatory control, and proof of work as, quote, doomsday economics. Now, although the working paper is couched in technical language, it's best understood in the context of its author's interests, since they're hardly neutral observers. The interests in question are, of course, maintaining the primacy and stability of the centralized, state-controlled financial system. So, without further ado, let's dig into Auer's latest research contribution. The paper uses two novel datasets to investigate the trends and drivers of cross-border flows of BTC, ETH, USDT, and USDC between 184 countries from 2017 to mid-2024. The most eye-popping finding of the report is the magnitude of cross-border crypto flows, which peaked at $2.6 trillion in 2021 alone. To put that into perspective, this sum was roughly equivalent to 12% of the total global trade in goods during that year. That's both absolutely nuts and a testament to crypto's success. It is now a globally adopted parallel financial system that has grown despite all the warnings and naysaying that the old guard institutions like the BIS could muster. The leading stablecoins USDT and USDC accounted for almost half of this massive volume, racking up $1.2 trillion in cross-border flows in 2021. This is exceptionally impressive considering that Tether's USDT reached a $1 billion market cap just 4 years prior. That's a seriously rapid pace of adoption. Now, two major drivers of these cross-border flows were trade and remittances, i.e. people who work abroad sending money home. The authors found, quote, signs that crypto transactions emerge as a substitute for remittance payments. Country corridors characterized by high remittance costs or slow processing exhibit larger crypto asset flows. This relationship is more pronounced for stablecoins than for unbacked crypto assets. It is also more pronounced for low-value BTC transfers than for large-value ones. With many workers now asking to get paid in crypto, we see this as the market's direct response to the inefficiencies of fiat currencies for cross-border transactions, where traditional banking is too slow, too expensive, or too restrictive. When it comes to mapping out cross-border crypto flows by country, the paper's authors acknowledge that this can only be an approximation. That's because blockchain pseudonymity and the prominence of offshore crypto exchanges of unclear domicile make it impossible to comprehensively attribute transactions to users. Nonetheless, they make a pretty convincing attempt, using quarterly data on flows between crypto exchanges, including labels attributing wallet addresses to particular entities. They then allocated entity flows to locations based on statistics on their user base. They approximate the geographic profile of crypto flows by complementing their data with app usage data of the respective exchange or the web traffic of a crypto exchange's website. So, for example, if 60% of an exchange's app usage originated from the US, then 60% of all crypto in- and outflows to this exchange were allocated to the US. With this method, they produced a pair of maps showing global BTC and USDT flows for the first half of 2024, with arrows between countries representing bilateral flows of $1 billion or more. The two maps couldn't be more different, with the vast majority of BTC flows either originating or terminating in the US, contrasting with a much more global distribution of flows in Tether's case. We suspect that the US-centric Bitcoin map might have something to do with the growth of the newly launched spot Bitcoin ETFs in this period. That's because they led to a sharp increase in the amount of BTC in the custody of Coinbase, which is of course based in the US. That would account for the concentration of flows in the US, but on the other hand, it doesn't explain the relative lack of flows between other countries. If you look closely, though, you can see that the UK is another major hub for cross-border flows. The paper explains that the UK and US accounted for about 20% of cross-border activity in BTC and USDC and close to 30% for ETH. It also points out that this map represents a significant departure from the earlier years in the period of study, when China accounted for a much larger proportion of flows. China has certainly tightened the regulatory screws since 2017, so this makes sense. And according to the paper, China's loss is India and Indonesia's gain, as their share of cross-border flows has been increasing. Moving on, the USDT flows for the first half of 2024 are a completely different picture, with broadly distributed arrows connecting territories all around the world, from Russia to the UAE, South Korea to South America, and the US to Western Europe and India, and so on. The authors highlight Turkey and Russia as two of the biggest players, accounting for 12% of cross-border USDT flows. As flows leapt from $10 billion in 2019 to more than $1.1 trillion in 2023 to 2024, Turkey apparently became the second largest receiver and sender of USDT. Just as the BIS has feared, crypto has enabled people to escape the fiat currency panopticon, or at least gain some degree of freedom within it, since we are talking about a US dollar-pegged stablecoin here after all. USDT has provided Turks with an escape from runaway inflation, and ordinary Russians with some degree of relief from Western sanctions. Now, having ascertained these flows, the authors then turn to the question of what exactly is driving them. For BTC and ETH, the paper points to speculative motives and global funding conditions. It's certainly true that people are buying these assets, and particularly BTC, because they're betting they will increase in value. But, seen another way, people are betting on the value of central bank-issued fiat currencies eroding over time. And this is not speculation, but a matter of fact. As a much harder form of money, Bitcoin is a hedge against this inevitability. Now, global funding conditions are inextricably linked to this because it is easy or loose funding conditions, meaning money printing, that causes the purchasing power of fiat currencies to weaken, thereby creating demand for such a hedge from people trying to protect their savings. By contrast, cross-border flows of stablecoins, and interestingly also low-value BTC transactions, are largely driven by transactional motives, particularly for remittances. This is further evidence of crypto solving real-world problems, namely high remittance costs. These costs are a feature rather than a bug of existing financial architecture, with crypto enabling low costs by circumventing rent-seeking intermediaries. The paper then uses something called a gravity framework to address the question of whether crypto is actually creating a borderless financial system, which is of course one of its core tenets. This framework predicts that cross-border flows between two countries will be proportional to their sizes and inversely proportional to the distance between them. In other words, bigger economies attract more flows, like how larger planets have a stronger gravitational pull. Meanwhile, distance creates friction and cost, suggesting less flows between faraway countries. Having applied this model to cross-border crypto flows, the authors found that, although economic size still matters, geographical distance and traditional barriers like sharing a border or language curb cross-border crypto flows far less than they do for fiat currency flows. Hence the paper's title, Defying Gravity. In other words, there's compelling evidence to say that yes, crypto has in many ways already created a borderless financial system, as crypto tends to flow around obstacles in the physical world in a way that fiat currencies do not. And this leads us to the next major conclusion of the paper, which is that capital flow management measures, or CFMs, are largely ineffective against crypto. The authors find that many people are able to circumvent CFMs by using crypto. Of course, what the BIS calls circumvention is likely experienced by these users as a better system that offers empowerment, financial sovereignty, and freedom. Now, if traditional levers of state financial control don't work on crypto, then it's rather a big win for crypto and for the individual. But for the state, it means the loss of policy control, threats to monetary sovereignty, and the potential for illicit finance. And that's why research like this from the BIS makes us a little nervous, because its findings will undoubtedly spur efforts to reassert central bank control over our financial destinies. And we can already see this in action, with the UK's Parliament, for example, recently voting to require crypto firms to collect and report to the government sensitive personal information on UK clients for every single transaction they are involved in. Any unreported transactions will be liable for a £300 fine. So, keep your eyes peeled for invasive measures like these coming to a jurisdiction near you if the BIS keeps yapping about how much financial freedom crypto affords its users. Folks, hold on to your sats because as crypto continues to grow, governments are going to try harder and harder to claw back the freedoms it allows us. The good news is that political opposition to CBDCs continues to pick up steam. And of course, we also have a wild card in play, namely a crypto activist US government. So, talk about friends in high places. And for all the latest on that unlikely oasis of crypto positivity, you can check out our video on President Trump's shitcoin banquet and how it might be colouring US crypto legislation right over here. I'll leave it there for now, folks, but as always, thank you for watching, and I'll see you next time. This is Guy, over and out.